The Minority Market. Episode 47. How to Handle Losses Calmly. Losses are unavoidable in the stock market. Anyone who tells you otherwise is lying. What separates the minority from the majority is not the absence of losses, but the ability to handle them calmly, logically, and without emotional damage. Most people treat losses as personal failure. When money is lost, the mind reacts with shame, frustration, anger, and fear. This emotional reaction is far more dangerous than the loss itself. Capital can be recovered. Mental stability is harder to rebuild once it breaks. The first step to handling losses calmly is changing how you view them. Losses are not punishment. They are feedback. They are part of the learning process. Every professional trader and long-term investor has experienced losses repeatedly. The difference is that they do not let losses define their identity. The majority reacts emotionally. They panic. They blame the market. They blame news. They blame brokers. They blame strategies. They look for someone to hold responsible. The minority looks inward. They ask what can be learned. They analyze their decision-making process instead of emotionally escaping responsibility. One of the biggest reasons losses hurt so much is improper risk sizing. When you risk too much on a single trade or investment, emotional attachment increases. Fear becomes stronger. Stress rises. Calm thinking disappears. The minority understands that emotional stability begins with controlled risk. Small losses are easy to handle. Large losses create emotional trauma. This is why professionals obsess over position sizing and risk management. They design their system to protect mental capital first, not just financial capital. Another critical aspect is expectation management. Beginners expect constant profits. They expect smooth upward growth. Reality is uneven. There are drawdowns. There are sideways periods. There are losing streaks. When expectations are unrealistic, emotional pain becomes stronger. The minority expects losses. They prepare mentally for them. They accept that losing trades are part of long-term success. This acceptance removes shock and emotional surprise when losses occur. Let us talk about emotional reactions immediately after a loss. This moment is dangerous. The mind is unstable. Judgment becomes distorted. Impulsive decisions become tempting. This is when many traders enter revenge mode. The minority builds rules to protect themselves during this phase. They take breaks. They step away from screens. They pause trading activity. They allow emotions to settle before making new decisions. A powerful habit is separating outcome from process. A trade can be executed perfectly and still result in a loss. That does not mean the decision was wrong. Markets are probabilistic. Outcomes are uncertain. The minority evaluates decisions based on discipline and rule following, not only profit or loss. Another mistake is attaching self-worth to market performance. When identity becomes tied to profit, every loss feels like personal failure. This creates emotional instability. The minority separates personal value from market results. They see trading and investing as skill-based activities, not validation tools. Let us discuss long-term perspective. One loss means nothing in isolation. 1 month of drawdown means nothing in a multi-year journey. The minority zooms out mentally. They focus on survival and consistency instead of short-term fluctuations. Short-term emotional pain disappears when viewed from long-term perspective. This mental zoom-out ability is a powerful emotional stabilizer. Another important tool is journaling losses. Writing down why you entered, what happened, and how you felt creates awareness. Over time, patterns emerge. You will see repeated emotional mistakes. Awareness gives you control. Losses also expose weaknesses. They reveal emotional triggers. They reveal system flaws. They reveal behavioral gaps. Instead of avoiding losses, the minority studies them. Losses become teachers. There is also a concept of emotional capital. Just like financial capital, emotional energy is limited. Overtrading, stress, and constant screen watching drain emotional capital. The minority protects emotional energy by reducing unnecessary activity. Rest, physical movement, sleep, and mental breaks are part of professional market behavior. Calmness is not accidental. It is built through lifestyle discipline. Another mental shift is understanding randomness. Even the best setups fail sometimes. Even strong companies decline temporarily. Accepting randomness reduces emotional attachment to individual outcomes. Calm traders do not seek certainty. They seek probability advantage. They do not demand perfection. They demand consistency. The market constantly tests patience. It tempts you to react emotionally. It rewards those who remain neutral under pressure. When you learn to sit with discomfort without reacting, you gain emotional power. This skill transfers beyond markets into life itself. The minority does not try to eliminate emotions. They learn to observe emotions without acting on them. They allow fear to exist without obeying it. They allow disappointment to exist without reacting impulsively. This emotional mastery is what creates long-term advantage. Handling losses calmly is not weakness. It is strength. It is not passive behavior. It is controlled behavior. And those who master this skill survive long enough to let compounding work in their favor. Because in markets, survival always comes before success.